All right, let's talk taxes. This will be section 8.2 in the book. And specifically, we're really looking at federal income taxes for the bulk of this particular section. Notice I have copied here on the screen the section from our formula sheet that talks about income taxes. This is on the front sheet in the bottom left corner, but it walks us through the steps that we need to pay attention to. We've got to understand what our adjusted gross income is, and that's our gross income minus any adjustments. Then we have to look at our taxable income, which is our adjusted gross income minus exemptions and deductions. And then we can calculate the income tax, which is our tax computation minus tax credits. So notice we don't have a list of formulas here so much as a list of terms. And we'll really need to understand what those terms are to best understand how to calculate our income taxes. So we'll start with our gross income. Gross income is all of the income you make over the course of a year. Notice that it includes specific things like your wages. We've got tips, any interest or dividends you make on investment income. If you get unemployment compensation, that would count as income. Any profit from a business, any profit from a rental income. So if you're renting your place out to somewhere, the profit you make there should be listed as income. Even game show winnings would count as income. And that's why those people who win the lottery or who win something on TV will end up paying a particular portion of that in taxes. Notice it also says it doesn't matter if your winnings are in cash or other items such as cars or vacations. So all of those winners on the game shows have to pay taxes on their new car or their new vacation or any of that they've won. Now we should differentiate between gross income and net income. Net income is income after taxes are taken out. So it's the amount you actually take home. Sometimes they call that take-home pay. And so the gross income is what you make. It's like if you get paid salary, say you get $30,000 a year as salary, that would be your gross income. And net income would be how much you actually take home, which would probably be about 80% of that. So you would take home about 24,000 of that 30,000. The rest of that would likely go to taxes. Now we need to define adjustments. That's what we're subtracting from our gross income in order to determine our adjusted gross income. And adjustments are defined as untaxed portions of our gross income, including contributions to certain retirement accounts. Say you've got a tax-deferred savings plan like an IRA, or even interest that we pay on our student loans would be an adjustment. So we don't have to pay taxes on that interest. We don't have to pay taxes on those contributions to a tax-deferred retirement plan. We don't have to pay taxes on our alimony payments if we've got those. So a number of things that we will subtract from that gross income in order to determine whether or not or how much we have to pay taxes. And remember, when you filled out FAFSA, that form to get your federal financial aid, they asked for the adjusted gross income. So they're not looking at gross income. They were looking at your gross income minus any of these adjustments. That was to determine basically how much money could be paid. And maybe they used the AGI of your parents. It depends on your living condition. But regardless, AGI was commonly what they were looking at. Notice now we jump down to taxable income. That's actually the amount of income that it will be taxed. We're not taxed on our full gross. We're taxed on this taxable income. So we now need to determine what our exemptions and deductions are. So let's define those. An exemption is a fixed amount. So it's just one lump sum, and it's based on how many people you're supporting with your income. And in 2016, which is when the book was written, the exemption was $4,050 per person. So if you are filing singly as a single individual with no dependents, you would get to claim $4,050 as your exemption. If you are married and filing with your spouse, then you would get to claim $4,050 for you and $4,050 for your spouse. If you have children or others in the home who depend on you, you get to claim $4,050 for each of them. Now, I would like to note that in the homework, there was a problem where they had an exemption that was not $4,050. And I'm not sure why they included that problem, but it is there. So watch, just in case they give you a different value. If they do not mention a specific value for exemption, use the $4,050. And as far as deductions go, that gets slightly more complicated in that we have two options to look at. We can take the standard deduction, which is just one lump sum amount that we will count as our deductions. It's been set by the federal government what that amount is. And the amount we will use in this class is different from the amount that exists today, as this was written before President Trump took office. And while he was in office, he changed through proper channels the standard deduction, almost doubling it, if I recall, which means a lot of people just take the standard deduction now. However, if you have a number of items that can be deducted, you may want to itemize your deductions. Itemized deductions would be the sum of a number of expenses that are not taxed. Some of those include interest on your home mortgages. That's not taxed. State income taxes are not taxed at the federal level. Property taxes are also counted as deductions. So you can see if you own your own home, that becomes a tax deduction because the interest you're paying on your mortgage, you don't have to pay taxes on. If you make charitable contributions, those get removed from your adjusted gross income before they figure how much you will be taxed. And then we've got medical expenses exceeding 7.5% of the AGI, or adjusted gross income. And so if your medical expenses become too large, then you won't be taxed on that. Now, we would have to determine whether your medical expenses exceed 7.5% of your adjusted gross income. And if they do, those that are above 7.5%, you would get to deduct. Now, notice this statement down here at the bottom. It says taxpayers should choose the greater of the standard or the itemized. So you would itemize your deductions and then compare that to the standard. If the itemized were greater, you would use that for your deductions. If the standard deduction is greater, you use that one. You do not use both. It's either one or the other. I have in the past benefited from itemized deductions. More recently, because of the doubling of the standard deduction, I tend to go that route as my itemized deductions do not come to a sum that is greater than the standard. So regardless, you will pay a little less in taxes because you're taking the larger of the two. I suspect the IRS wouldn't complain too much if you chose the lesser of the two, though they do tell us we should take the greater of the two. So I'm going to remove these definitions real quick so that I can show a sample problem and we'll see what we're talking about here. So let me again scroll back up here. For this sample problem, We have a single man who's earned wages of $46,500. He received $18.50 in interest from a savings account, $15,000 in winnings on a game show, and he contributed $2,300 to a tax-deferred savings plan. He's entitled to a personal exemption of $4,050 and a standard deduction of $6,300. The interest on his home mortgage was $6,500. He paid $2,100 in property taxes, $1,855 in state taxes, and $3,000 to charity. We're asked to find his adjusted grossing, well, his gross income, his adjusted gross income, and his taxable income. So let's go ahead and figure this out. So his gross income would be the sum of all of his income amounts. So let's see what we've got here. He's got wages. He received interest from an account, and he received $15,000 in earnings. Those would all be considered income. His contribution to a tax-deferred savings plan would be an adjustment. So I'm going to go ahead and put a box around that, but as a different color, because that would be an adjustment. He's entitled to an exemption. So go ahead and change colors here. His exemption would be the $4,050. And then he's got some adjustments. Let's see what would be included there. Not adjustments, deductions. So we've got $6,300 as a possible adjustment. We've got $6,500. I said adjustment again, it's a deduction. We've got $2,100 in property taxes. We've got state taxes. Those would be all deductions, as would a contribution to charity. So we'll have to compare the itemized versus the standard. And you know, I see the interest on the home mortgage was greater than the standard. So I'm going to go ahead and cross out the standard deduction because I know the itemized deductions are greater than that. So I cross it out so I don't make the mistake of accidentally including it. So his gross income would be the sum of all of his various income endeavors. So $46,500 in wages, plus his interest of $1,850, plus his winnings from a television game show. And so I'll add all of those together. Got $46,500 plus $1,850 plus $15,000 gives $63,350. That's what he received in income that year. Now his adjusted gross income, or AGI, would be his income, which we just calculated was $63,350, minus any adjustments. And notice I put the adjustment in kind of a maroon box, so I knew what that would be, minus the $2,300. And that gives me a total of $61,050. That would be his adjusted gross income. So that would be the income that was mentioned on a FAFSA report, for example. Now his taxable income would be his adjusted gross, which we calculated as $61,050, minus his exemptions, and that was $4,050. As a single man, he only gets the one, plus the sum of his deductions. Now I'm going to, over here on the side, look at deductions. I've already seen that the standard will not be used, but I'm going to include that here just to show that the standard was $6,300 for a single individual. Now itemized, we need to add all of the others that he had. So he had $6,500 in interest. He paid $2,100 in property taxes. He paid $1,855 in state taxes, and he contributed $3,000 to charity. So when I add those together, get a 5 and a 5. 8 and 1 is 9, plus 5 is 14, carry the 1. 6 and the 1 is 7, plus the 3 down below is 10, plus the 2 and the 1 are 13,000. So 13,455, and that's definitely greater than the 6,300. So I won't use the 6,300. Instead, I'll use the 13,455. Now, I would like to show you that we can, if we so desire, distribute this negative through. And we talked about that when we were doing calculations. So sometimes I will write it as 61,050 minus 4,050 minus 13,455. That's usually how I think about it, because deductions are subtracted from the AGI, as are exemptions. And so I usually think of it as a total subtraction. So the 61,050 minus 4,050 minus 13,455 gives me a taxable income of $43,545. So that is the amount on which this gentleman will be taxed. Notice his wages were $46,500. He's not even taxed on that full amount. Even with these extra incomes, it didn't push him beyond that. So we're not really taxed fully on our gross income because of all of these adjustments, exemptions, and deductions. We're taxed on this taxable income, which makes things a little easier on our pocketbook, as we are not required to pay taxes on everything. Something to think about. Now let's take a look at how these taxes come to be. And this is where it perhaps gets the trickiest. We've got here a tax table. What one would do is bring that taxable income, and let's see, that was $43,545 for this individual. Well, you know what? I want to put that on a separate layer. So I still want it there. I just don't want it on that table in case I want to bring that table up later. We don't need that extra number sitting around. So the taxable income in that last problem was $43,545. Remember, it was for a single gentleman. So we have a single table here, a single column, I should say. We also have a column for married filing separately. You may be married, but it may benefit you for you and your spouse to file your own income tax returns. It's not uncommon for married people to file together, and that would use this third column of married people filing jointly. And then we have the head of household column. That happens when you are unmarried, but you have a number of people in your home who depend on you for their livelihood, their care. And I have filed as single, head of household, and married filing jointly. I've never seen it to my benefit to file married filing separately, though some people may. Say one of you has a business and the other has work that they do outside of the home, or maybe one person won something and the other didn't. There may be benefits to look at. Something to pay attention to is down here, the second row from the bottom is the standard deduction. We used 6,300 in our example because it was a single individual. Notice that if you are married filing jointly, the standard deduction is twice that of the single. So it's 6,300 per person. If you're married filing as, unmarried, but filing as head of household, your standard deduction is 9,300. And so Again, depending on your filing status, that might affect the standard deduction. Notice across the board, the exemption is $4,050 in this table per person. Don't forget that. That's per person. So watch for that when you're going through your calculations. Now, how do we do this? Use this tax table. Our taxable income in our sample problem was $43,545. Notice the tax rate is 10% up to $9,275 if you're filing single, as our problem, the person in our problem was. From 9276 up to 37,650, there's a tax rate of 15%. Our person has a taxable income that is greater than 37,650. As a matter of fact, it falls in this third row. I like to cross out the largest value and replace that with their taxable income. It's easier for me to see what's going on. And I'm actually going to ignore these other three columns, as the person in our particular problem was not filing as married or head of household. So now we can hone in on this single individual, the single column. Their income was not anywhere in these lower rows, so I'm just going to cross those out as well. However, I do need to use all three rows that exist, because while the 43,545 does appear in the third row, their whole income is not taxed at that tax rate of 25%. The first 9,275 of their 43,545 is taxed at 10%. So we would take 9,275, subtract 0 from that, and multiply that by 10%. And we get $927.50. And then we look at the second row. All of the money, all of their taxable income between that 9,275 all the way up to 37,650 is taxed at 15%. So we'll take the largest number in that row, 37,650. We'll subtract from that the largest number in the row above it, and we'll multiply that by the new tax rate. So 37,650 minus 9,275 is 28,375, and I multiply that by 0.15, and that gives me 42.56 and 25 cents. And now we go to the third row where their income would sit. So we take their income minus the largest number in the row above that, the 37,650. And that's the amount that will be multiplied by 25%. So I'll take the 43,545, subtract from that 37,650, and multiply that by 0.25, and I get 1473 and 75 cents. And now I add those together. So 1473.75 plus 4256.25 plus 927.5 gives me 66.57.5 or 50 cents. That is how much that individual owed in taxes for that year. If we had just multiplied the 43,545 by 0.25, it would be 10,800, which is much higher than this. And so this is another way that we are helped in that we don't have to pay as much in taxes. We can just take this graduated tax and figure out which portion of our taxable income gets taxed at which rate, and then sum those together. So let's look at a sample problem and see if we can figure out this individual's taxes. So we've got a single woman with no dependents. The gross income is $62,000. The adjustments are $4,000. They paid that to a tax deferred retirement account. They have a list of deductions there, and then a tax credit, which we didn't quite hit on yet, but I do want to show you again really quick from our formula sheet. I need to hide that sample problem. We can see that the tax credit shows up at the end. After we've done our tax computation, that's what we get from the table, we subtract from that the tax credits. And that gives us how much we will either owe or how much we will get back. The credits are like how much you have paid into taxes from every paycheck over the course of the year. And so if your tax credits are greater than how much you owe, you'll get a refund. If your tax credits are less than how much you owe, you will have to pay the difference. So let's look at this problem. They've got it already broken out. We know the gross income. So we need to start with our adjusted gross income, which is the gross minus any adjustments. And we have our gross income is 62,000. Subtract from that the adjustment of 4,000, and that would be 58,000. So that is this woman's adjusted gross income. And now we get their taxable income, which is their adjusted gross income minus exemptions and deductions. So we've got her adjusted gross income. Now this problem doesn't list exemptions, but I have the portion of the tax table here that applies for single individual, and the exemption is listed down below as $4,050. We've talked about that already. Minus deductions. Now the standard deduction again is $63,000 or $6,300 for a single individual, but she has a list of deductions here that is larger than 6,300. So we're not going to use the standard, we'll just use the itemized. So we've got 7,500 in mortgage interest. We've got 2,200 in property taxes. We've got 2,400 in charitable contributions. And then she's got some medical expenses. Remember, medical expenses had to exceed 7.5% of the adjusted gross. So let's see, the adjusted gross times 7.5% would be $4,350. That's what the medical expenses would have to exceed. This does not, so we're not going to include that. Had it exceeded $4,350, then we could have subtracted some of the medical expenses. They didn't, so we won't. 58,000 then minus 4,050 minus 7,500 minus 2,200 minus 2,400 gives us a taxable income of 41,850. So that's what we'll take to the tax table. And I see, just like in our last example, 41,850 is in the third row. I'm going to go ahead and cross out the rows below that so that I don't get confused. And I will go ahead and calculate this out. So our tax computation would be what we get taking the taxable income to the tax table. So we have 9275 minus 0 at 10%. Then the next row we have 37,650 minus the highest in the previous row, 9275. And that will be taxed at 15%. And then we have her income minus the max in the previous row times 25%. So let's add all of those together. 10% of 9275 is 927.50. I know I did this calculation last time, the 37,650 minus 9275, and then multiplied that by 15%. It might be worth remembering those since those won't change. If your income is greater than those first two rows, those taxes will maintain the same. Now this third row, we've got 41,850 minus 37,650, and we multiply that by 25%, which is 1050. So we add all of those together, 1050 plus 4256.25 plus 927.5 gives me 6233 and 75 cents. That's her tax computation, and then we'll subtract the tax credit from that because she already paid $500 in taxes for the year. And we get that she needs to send a check to the IRS for $57,733.75. That's the tax owed at the end of the year. And so she goes through and calculates that, and by April 15th, she sends a check to the IRS for $5,733.75. That's how one might calculate their federal income taxes. And again, you'll have problems where you'll have somebody who's filing jointly with their spouse. So we won't use the single column, we'll use that third column over. The standard deduction is larger, it's 12,600. Exemptions are still as we expect. And they may have a greater income. And so you may have to go 5 rows down, but the process is still the same. That will allow us to calculate our federal income taxes, which are actually due in about a month. If you look at your pay stub, you'll notice that sometimes you have FICA taxes taken out. FICA taxes go to pay for Social Security and Medicare benefits. FICA stands for the Federal Insurance Contributions Act. It allows us to pay for those who are older in society. And so when you get to be that stage and are ready to collect Social Security or get Medicare benefits, that will be paid for by people who are at that time having FICA taxes removed. Notice that the setup is about the same as we have for the federal income tax. We've got a table here, and notice that we are charged a certain percentage for the first portion of our income, up to $118,500. We pay 7.65%. If you make anything over the 118,500, then that portion above 118,500 is taxed at 1.45%. Also notice that those are employee rates. Your employer matches that. They pay the same amount to FICA that you're paying out of your income. And so the government gets twice as much. And also notice that if you're self-employed, you're paying for both the employer and the employee. So if you're self-employed, you do pay twice as much as if you are employed by somebody else. And so noting exactly what your status is, whether you're an employee or self-employed, you can know how much to pay in FICA taxes. And you would do the same sort of calculation. If, for example, you were not self-employed and you made $150,000 in a year, then the first 18,500 would be taxed at 7.65%, and then your 150,000 minus the 118,500, so just that portion above 118,500 will be taxed at 1.45%. And so once again, you'll do those products and you'll do those multiplication problems and add their products together to get the total FICA taxes. So to end, let's grab a problem that's a little closer to home, perhaps. You want to get a little extra spending money, so you take a part-time job at a local gym. The job pays $15 an hour. You work 20 hours per week. Your employer withholds 10% of your gross for federal taxes, 7.65% for FICA, and 3% for state. And they ask us several things. What is your weekly gross pay? So to do that, we'll take our $15 per hour, and we will multiply that by 20 hours per week. Notice that the hours cancel, just like in our dimensional analysis, and we get dollars per week. So 15 times 20 would be $300 per week. That would be our gross weekly income. How much is withheld for federal taxes? Well, we'll take that 300 and we'll multiply it by the 10% that is withheld. So we would lose $30 per week to federal income taxes. And that is determined based on what numbers you put into your W-4 when you're hired. The amount withheld for FICA taxes, we go back to our gross, multiply that by the 7.65%. So 300 times 0.0765 would be $22.95. That would be taken out for FICA taxes. Then they ask how much is withheld for state taxes. That was 3%. So 300 times 3% would be $9. So the weekly net would be the gross minus federal tax, minus FICA tax, minus state tax. Feels like we're having taxes taken out all over the place, huh? And so one might ask, what's the value? If I make $300, but I'm only taking 238 of that home, what do I get for that extra? Well, let's consider the things that we don't necessarily have to pay for to get them to happen, like fire and police and schools, our roads. Some of our roads are paid out of gasoline taxes that are added in there on the state, but some are not. So we get a number of benefits that help us, even though we don't get as much money home in our paycheck as we might like. And so we have to consider those benefits that come about to help perhaps ease our anxiety that we're not taking home as much money. And maybe you don't have firemen and policemen coming to your home or protecting you as much as you notice. Maybe those are going to save somebody else. The days I need it, I'm glad they're there. So it may be worth it that I'm paying those taxes. Plus, those people need to be paid to be prepared to come help me. So sometimes we're doing that, is paying for the preparation, like insurance, I suppose. The final question is, what percentage of the gross pay is withheld for taxes? So let's take everything that is withheld for taxes, and we'll divide it by our gross pay. That's how we get the percentage of something that goes to a value. So we'll take that 30 and the 22.95 and the 9, add those together and divide it by 300, and we get 0.2065. Remember, to convert a decimal to a percentage, we just move the decimal over twice. So that's 20.65%. They say round to the nearest tenth. That's the spot just to the right. So we look to the number to the right of that, which is a 5. So we need to bump this one up, and it would be 20.7% of our weekly gross goes to taxes of various types. So that's the general gist of our taxation section. It's tedious at times. We'll do a lot of calculations, but it's not tough calculations. We just have to know those words that we're using and plug the right numbers in at the right times. But it's mostly just arithmetic, adding, subtracting, multiplying, and dividing. We are rarely doing anything fancier than that here. So hopefully it's not too bad. But if you do have questions, definitely reach out. Good luck, and let me know how it goes.